Pleasant day to the happy and smart learners. I'm Dr. Shobha Edward, Principal and Head of the Department of Corporate Secretaryship, KCS Kasinada College of Arts and Science. So now we will be looking into one question under the head income from house property. So there goes the solution for this question. Here, there are two houses. The first house, the municipal valuation is 3,75,000 used for his own residence. And the second house is of municipal valuation 6 lakh, which is let out. With the following expenses, municipal taxes paid, land revenue, interest on loan for reconstruction. Now, going on the solution for this question. House 1, which is self-occupied, the annual value is nil, and the only deduction that we give for a self-occupied house is interest on loan for reconstruction. So here, the interest on loan is restricted to 2 lakh, though his actual interest on loan is 3 lakh 20. It is limited to 2 lakh. So hence there is a loss from house property for the self-occupied house, house 1. Moving on to house 2, the let out house. So the annual value is calculated. MRV is the only value given. So 6 lakh is the annual value, less municipal tax, which is 1 lakh. And we get the net annual value after deducting the municipal tax. Standard deduction under Section 24, 30% is allowed from the net annual value, and the interest on loan for the second house is also deducted. So finally, the income from house property is 3,29,000. So there is a loss from house 1 and an income from house 2. So this is how we calculate the value of income from house property when there are multiple houses. Thank you. Have a happy and smart learning. Thank you.